Welcome to another unit in this course on economics, whereas this time I'm going to talk about the foreign exchange market. But before we actually get to the foreign exchange market as such, I want to introduce some basic concepts and terms first. And the first thing we can start with is the idea of an exchange rate. And with exchange rates, we have two perspectives we can take, as with nominal and with real exchange rates. Whereas the nominal exchange rate, which in economics notation is the small e, is what you usually see if you go to a bank or a money changer or whatever. That's the nominal exchange rate they report. And even if you see the nominal exchange rate, even there are two possible ways to report it. The first one, if we take the example euro US dollar, with euro being the domestic currency, then the first idea would be the price quotation or direct quotation. And that's how much do I have to pay in domestic currency for 1 unit of the foreign currency. So how much euros do I have to give you for 1 US dollar? The alternative would be the quantity quotation. That's more or less the question, how much of the foreign currency do I get for 1 unit of my domestic currency? And that's more or less the standard in economics. We would usually only work with the quantity quotation because this has one big advantage. If the euro becomes more valuable, this means I will get more US dollars. So the exchange rate, the nominal exchange rate, will increase. In other words, so if the euro gains in value, we call this as well appreciation. The euro appreciates. So if the euro appreciates, the exchange rate will increase. And this works the other way around as well. If the euro loses in value, we call this depreciation, or the euro depreciates. And if the euro depreciates, then the exchange rate will decrease if we use the quantity quotation or indirect quotation. That's why this is not only the standard, but the most sensible way to use here. Well, that's already the perspective nominal exchange rate. So we can also talk about the real exchange rate. And to introduce the idea underlying the real exchange rate, I prepared a short illustration here. And we can start on the very left. Usually we do not do this with rows, we do this with the whole representative basket of goods. But I think it's more illustrative if I start with the example. I'm going to a German baker. I'm buying 3 rolls. Then I have to pay the price per roll. Assume like the price per roll is 1/3 of a euro. So the price for 3 rolls is actually 1 euro. What I'm doing here is I take the quantity, 3 rolls, and I multiply this with the domestic price level P, which is 1/3 of a euro per roll, giving me 1 euro. If I want to know how much the 1 euro is worth in US dollars, I'm going to multiply this with the nominal exchange rate, which here I assume to be $1.5 per euro, meaning I will get $1.5. Then I want to know how many rolls in the US can I actually buy for $1.5? So I'm going to subtract this, divide this by the foreign price level, which here is the P star. So I divide the $1.5 by, in this case, I assume 1 roll in the US costs $0.3. So I divide this by this expression, giving me 5 rolls, which I get for my $1.5. So in this case, I can relate 3 German rolls to 5 US rolls. And that's actually what the real exchange rate is all about. This tells us that to get from German rolls to US rolls, I have to divide the 5 by the 3. So the real exchange rate in this context from one real good to another real good is 1.67, which is 5/3. Meaning the German rolls are worth more than the US rolls. Well, now, as I said, it's not about rolls. It's about the representative basket of goods. So we would say the German representative basket of goods, if we have the same numbers, is worth 1.67 times what the US representative basket of goods is worth. So here, due to the fact that worth of a basket of goods usually also represents quality of these goods, we can assume that the German basket of goods, the German rolls, are of higher quality than the US rolls, if quality in this case is perfectly related to price. We can also see that in this situation, comparatively, the US has a monetary advantage, has a comparative advantage to Germany in the production of rolls, because they're comparatively cheaper. So if we go about specialization, we could assume that the US might specialize in rolls and Germany won't. So the real exchange rate, which is simply price level, domestic price level, times exchange rate divided by foreign price level, as is summarized here in this situation, not only tells us something about the exchange from one real basket of goods to another, also tells us a lot about competitive positions, quality of goods, and so forth. So it's a really useful tool in multiple applications. And we can also use this to compare it with the nominal exchange rate and see whether the nominal exchange rate, as in this case, is smaller or whether it's larger. So whether we can assume that the euro at the moment is undervalued, as is the case here. So this exchange rate is smaller than this, or overvalued, with the assumptions underlying this that an overvalued currency will depreciate and an undervalued currency will appreciate, at least in the medium to long term. And well, that's then the comparison between nominal and real exchange rates. However, we can introduce a third, well, let's not call this type, but a third exchange rate. And that's the exchange rate if we assume that arbitrage is happening, that a lot of trade is bringing the goods from the cheaper location to the more expensive location. Meaning, in the cheaper location, the good will become scarcer. In the more expensive area, will become less scarce. So the prices will increase in the cheaper area, the prices will decrease in the expensive area. Meaning the prices will get closer and closer to each other, except of course transportation costs. So in the end, the prices will actually get to a similar level. If we have this situation, which was also in some cases referred to as the law of one price, we get an exchange rate which only depends on the still remaining different price levels. So we don't really have a normal exchange rate as before. We just have like residual differences which are expressed by this so-called purchasing power parity exchange rate, which is here simplified as exchange rate PPP. So this assumes that after trade, prices have more or less adjusted to a stable relation. So this is the third type of exchange rate I want to introduce here. Of course, we can carry on with like effective exchange rates to a certain basket of goods we can use in this context, which we then could use to like establish some kind of, let's call this like absolute value of the currency as compared to the relative version we have used before, because we always compare this only to one other currency. An absolute position would include the comparison to basically everything, or being independent of any comparison. So the closest we can get to an absolute value of a currency would be something like an effective exchange rate, like the average exchange rate to a very large basket of other currencies. However, I do not want to go into so much detail on these types of exchange rates. And instead, I want to say a few words about the different types of exchange rate regimes, whereas we mainly differentiate between fixed exchange rate regimes, meaning our nominal exchange rate is fixed, is constant, cannot be changed. And even if we have a pressure to appreciate or depreciate, the central bank will actively interfere in the market to keep the exchange rate constant. Compared to this, the exact opposite would be a flexible exchange rate regime. The exchange rate can change in any which way. The central bank will not interfere in the development of the exchange rate in any which way. So for example, the exchange rate euro-dollar is more or less perfectly flexible, whereas the exchange rate of the Bulgarian lev and the euro is fixed, or the US dollar and a lot of other currencies. That's also a fixed exchange rate, but not due to the fact that the US fixed the dollar to any currency, but that a lot of countries selected the dollar as the currency to which they fixed their currency. So that's like my concluding remark regarding exchange rates. We already talked about appreciation and depreciation. And we can only conclude this session with an idea of what it's actually called for, as with how would the foreign exchange market as such look like. Well, as I already said, the main actor on the foreign exchange market is the central bank, especially the main supplier is the central bank, and the central bank offers a certain amount of foreign currency in this regard, so that's why it's fixed. The demand for currency can have multiple reasons, multiple origins. This could be you trying to get additional foreign currency for your next holiday. This could be companies who want to invest abroad and need foreign currency to, for example, buy a different company abroad. So that's actually flexible, reacting to the exchange rate. Here, we assume that the central bank offers the foreign currency independent of the exchange rate. Well, that's then basically it with regards to the foreign exchange market. So I hope you enjoyed this session. I say goodbye and see you next time.